Hey everyone, welcome back. It's Finance Friday, another special edition of Money Girl. This is the show where I answer your burning money questions. I love hearing from you, so if something finance related is on your mind, leave me a voicemail. You can call 302-364-0308. You can also send me an email by visiting my contact page at lauradadams.com. Today, we have a terrific question that comes to us from Lisa S., who says, "Love the podcast. I recently left a 40-hour-a-week job for a 20-hour-a-week job, but it has benefits, including a 401k with an employer match of 4%. In addition, I also have 2 per diem side hustles that also offer 401ks, but neither of them pays matching contributions. Should I contribute 4% to the 401k with a match and then contribute more to the per diem 401ks? I don't want to be strapped if I only work 20 hours, but I want to be sure that I'm contributing more when I earn more. I also have a traditional IRA, but would rather take advantage of the benefits of contributing from my paycheck. Thank you." Lisa, thank you for your question, and congratulations on having multiple income sources. Having lots of retirement accounts is a terrific problem, and I'll help you maximize them so you earn more, reduce taxes, and build a secure financial future. So first, let's talk a little bit about employer retirement matching. I love that Lisa is focused on the employer matching that she's eligible for at her new job. That should definitely be a priority when you work for a company or an organization that offers a retirement plan with matching funds. That could be a 401k, 403b, or 457 plan. A retirement account match is when an employer contributes to your retirement plan based on how much you put in, up to an annual limit. While employers are never required to offer you matching contributions, many do because it's a valuable benefit. It helps them attract and retain good employees. Retirement plan matching can also encourage you to participate in a retirement plan, so you invest at least enough to maximize that additional free money from your employer. So if you're not maxing out an employer's match, you're essentially saying no thanks to free money, and I definitely don't recommend that. So let me give you some retirement matching examples. Companies usually choose to pay either a partial or a full retirement match. With a partial, your employer matches a portion of your contributions to your account up to a limit. For instance, let's say you're receiving 50% of your contributions up to 6% of your salary. So let's say you're earning $100,000 annually. In that case, 6% of your salary is $6,000. So if you contribute at least $6,000 over the year, your employer will match 50% or contribute $3,000 on your behalf. Now, what Lisa mentioned is likely a full employer match. That's when your employer matches 100% of your retirement contributions up to a limit. For instance, if Lisa earns $100,000, the maximum match with her employer is 4%. So that would be a $4,000 match. When you contribute to a workplace retirement plan, contributions from your own paycheck are immediately 100% vested. That means you own them and can take them with you if you leave an employer. However, most companies have a vesting schedule for matching contributions. That means the matching funds and their growth aren't officially yours to keep until you're fully vested. But if you're partially vested, you may be eligible to keep a certain percentage of the matching funds and their earnings if you leave the company early. The 2 main types of company vesting schedules are called graded and cliff. Graded vesting is the most common, and it gives employees benefits gradually over several years. That allows you to own a percentage of the benefits, even if you leave the company after a year or 2. A typical graded vesting schedule could be something like the following. It's based on the number of years of work that you complete. It could be something like after year 1, you're 20% vested. After year 2, 40% vested. Year 3, 60% vested. Year 4, 80% vested. And you have to complete 5 years to be 100% vested. Again, this is just for the matching contributions in your account. Cliff vesting is different because it happens all at once rather than gradually over time. For instance, your employer may require you to stay with the company for 3 years to become fully vested, and they may not offer any partial vesting. Once you complete 3 years of service, 100% of employer contributions would be yours in this example. But if you leave before completing the full amount of the cliff vesting years, you will get no benefit. So it's important to understand your vesting schedule before leaving a company. Now, we need to mention the 401k contribution limits because no matter the type of workplace retirement plan you have, there are annual limits to how much you and your employer can contribute. But here's the good news. Employer matching does not count against an employee's annual contribution limit. For 2025, you can put up to $23,500 into most workplace retirement plans. And if you're over 50, you can make additional catch-up contributions. However, the total contributions from you and your employer are 100% of your salary up to $70,000, plus any catch-up contributions you may qualify for based on your age. Now, for 2026, the annual contribution limit for workplace retirement plans will increase. It's going up to $24,500. And the total contributions from you and your employer will be 100% of your salary up to $72,000 plus any applicable catch-up contributions when you're over 50. So, it's going to increase a little bit in 2026. Note that the annual retirement contribution limit applies as an individual, not per account. So in other words, if Lisa's under 50, the most she could contribute across all 3 of her 401ks in 2025 is $23,500. But as I mentioned, her matching contributions are not included in that annual threshold. Since matching contributions are free money, you receive an immediate return on your investment. That's why they're so great. If you receive dollar for dollar matching from an employer, you double your money as soon as you contribute. So that doesn't even account for the growth those matching funds may earn through your chosen investments. However, to reach your retirement goals, you likely need to contribute more than what's necessary to max out matching funds. A good rule of thumb is to invest at least 10% up to 15% of your gross income annually. For instance, if your employer matches 4%, ideally, you'd contribute 11% of your own funds to reach a 15% target. And I'd say even if you don't receive 401k matching, it's still wise to contribute at least 15% of your gross income for retirement. If you don't have a workplace retirement plan, you can consider investing through an IRA, an individual retirement account. I'll talk a little bit more about those, or even a plan for the self-employed if you have part or full-time business income. So getting back to Lisa's question, after contributing 4% to the new 401k, what's her next best move? Well, since Lisa wants to contribute more as she earns more, I really like the idea of contributing a percentage of her per diem income to those 401ks. That's a really convenient and easy way to automatically save more for retirement. However, as I mentioned, Lisa must keep track of her total 401k contributions so she doesn't exceed the annual limit of $23,500 for 2025 or $24,500 for 2026 across all her plans. Otherwise, she'll have an excess contribution that must be corrected to avoid a penalty. If Lisa has more than the annual workplace retirement limit to invest, she can make a separate IRA contribution in addition to the 401k limit. For 2025, the IRA contribution limit is $7,000 or $8,000 if you're over 50, and the limits will increase in 2026 to $7,500 or $8,600 if you're over 50. However, the deductibility of traditional IRA contributions might be limited or eliminated based on income when you also participate in a workplace retirement plan. So typically, if you have higher income, the tax benefit will be limited on having an IRA and a workplace retirement plan. But another option is for Lisa to contribute to a Roth IRA if her income is under the annual limits. So, for instance, to make a full Roth IRA contribution in 2025, a single taxpayer must earn less than $150,000 or less than $236,000 if you file taxes jointly as a couple. For 2026, the Roth IRA income cutoff will increase. It's going to go up slightly to $153,000 for single tax filers and up to $242,000 for those filing jointly. Technically, there's no limit on the number of retirement accounts you can have. However, there are strict contribution limits for each type and income limits that I just reviewed for using a Roth IRA. To sum up, I recommend that Lisa, number one, max out her 401k match by contributing at least 4%. Number two, use her per diem 401ks to contribute an additional 6%, maybe up to 11% of her gross income when possible to get up to that 15% target. And number three, use her traditional or Roth IRA to make additional contributions once she reaches the annual 401k limit. And again, that's $23,500 for 2025. Lisa, thank you again for the question and good luck with your new job. Remember that I'd love to hear your voicemail call or read your email, and I'll put the phone number in the show notes for you to leave me a voice message with your comment or question. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast. We've got a great team that works on the show. Steve Rickyberg audio engineers the podcast. Holly Hutchins is our director of podcast. Morgan Christensen is our advertising operations specialist. Rebecca Sebastian is our marketing and publicity manager. And Nathaniel Hoops is our marketing contractor.